Money is supposed to be a measuring tool, a neutral way to compare effort, productivity, and value. So here's the mystery. If money measures value, why does it feel less reliable every year? Why do prices rise faster than wages? Why does saving feel punished while debt feels rewarded? And why do governments seem able to create money endlessly without creating wealth? Because at some point, money quietly changed its job, stopped reflecting reality, and started enforcing policy. Setting the stage when money had weight for most of history, money had limits. Gold, silver, and other hard assets required labor to produce. That scarcity acted as a natural brake on power. Kings couldn't spend forever. Wars were expensive. Bad decisions showed up quickly in the currency. But as nations grew larger and ambitions expanded, those limits became a problem. Governments needed flexibilities, especially during war and crisis. And that need set the stage for a transformation. Origins from value to trust. Paper money began as a promise, claim on something real stored elsewhere. It worked because people trusted they could exchange it for value, but trust created opportunity. Governments discovered they could issue more paper than they could redeem if people didn't ask for it all at once. Slowly, money shifted from being backed by assets to being backed by belief. The system didn't break. It stretched, and stretching became normal. The rise of central banks and controlled the 20th century accelerated everything. World wars required massive funding. Gold couldn't keep up. So central banks were empowered to manage money supply, set interest rates, and stabilize economies. Money stopped being neutral. Interest rates were engineered. Credit was expanded deliberately. Inflation became acceptably unuseful. Money wasn't measuring value anymore. It was shaping behavior. The breaking point, no more anchors. Eventually, the last formal link between money and tangible value disappeared. From that moment on, money could be created without physical limits. The consequences were delayed but unavoidable. Asset prices rose faster than wages. Debt became permanent. Savings lost purchasing power. Money didn't collapse. It drifted away from reality. Fall out of a debt-driven world today, the effects are everywhere. Governments run permanent deficits. Corporations rely on cheap credit. Households borrow to maintain living standards. Every crisis is met with more money. Every correction is softened, but nothing truly resets. Failed fixes, treating symptoms. Each downturn brings new solutions. Stimulus, rate changes, liquidity injections. But these fixes treat money as the solution. When money is the tool, you can't print productivity. You can't legislate value. So the system survives by delaying consequences. Modern parallels, the pattern repeats: record global debt, soaring asset prices, declining affordability. Money flows free, yet feels scarce. That's not a glitch, it's policy. 3 takeaways. First, when money becomes policy, it stops telling the truth. Second, inflation is a consequence, not an accident. Third, monetary systems don't collapse suddenly, they erode quietly. Warning and call to action: history shows that money cannot stay disconnected from value forever. The only question is who pays when reality reasserts itself. If this video changed how you see money, subscribe for more deep dives into debt, power, and the hidden mechanics of the global financial system. Because when money becomes policy instead of value, the bill always comes due.